If you are studying for the life and health insurance exam and want to know exactly how insurance contracts work, this is the deep dive video to watch. My name is David Duford, and today we're doing a fundamentals overview of everything that you need to know to pass the life and health insurance exam, and specifically ACE, the many questions involved with insurance contracts. And this is very important because a large portion of your presentation, or I should say your exam, is going to be involving contract terminology, what it means, how it works, how insurance contracts work. And if you don't understand it, you're going to fail. We don't want you to fail. We want you to get past this exam stuff so you can go out there, make some money, help some people, and enjoy yourself. So, specifically, what we're going to be learning today are elements of a legal insurance contract. You're going to understand the different characteristics of how an insurance contract works, how contract law and policy ownership work, how beneficiaries, premium provisions, riders, and policy provisions work, as well as contestability, grace periods, reinstatement, and settlement options. Pretty much anything that you've seen or heard is important relating to passing your life and health insurance exam, then we're going to be covering it in today's video. So why should you learn from me? Why should you spend some time with me on this deep dive? First of all, I've been doing life and health insurance sales since 2011. I have more than 15 licensed years as an insurance agent. I've also recruited and built my own agency since 2013, over 6,000 agents trained, many of them just fresh out of getting their license, just like you are. Our agency has done more than 30,000 policy sales since we started back in 2013. And I've also authored 4 best-selling books on various insurance topics. You can find out more if you go to daviddeford.com. Point is that education is central to what it is that we do, what I do. I've been doing YouTube since 2014, and I love doing this content, and I love teaching, and I'm passionate about, more than anything else, getting past this exam so you can actually sell and start helping people with their insurance needs. So, a couple other things I just wanted to mention here, some shameless plugs, is my free life and health exam coach community. The reason this is important is this is an extension of the training we're about to get into. This is one of 12 deep dive modules that we do and cover that are very important for you to pass the exam. All of this is 100% free. And along with today's presentation, you can download the slides. We also have access to practice exams, quizzes, flashcards to help you study, daily practice questions. There's a great community if you'd like to join that, as well as all of the videos that we've compiled. And this is completely and utterly free. Why do I do it free? Because I love what I do. I love teaching people and getting them into this awesome business, having myself be an agent and an agency owner. And I want to invite you to encourage you to join. If you look at the link below, school.com/life-health-exam-coach, that's a mouthful, or just better yet, skip all this, look below. You'll see the link in the description. It's free. Join. Nobody's going to harass you to do anything other than pass your exam. That's the goal. Now, with that said, a couple of notes here. This deep dive fundamentals video, you're going to see timestamps. So if there's something specific about insurance contracts that you want to study, you don't have to watch this thing from start to finish. You can just go to the section that's most confounding and confusing, and you'll get your answers and clarification there. In each of the sections, we go over in detail exactly what the topic is about, how it's applied in the insurance world, and equally important, how it's going to show up on the examination so you can be prepared for those gotcha questions so that you can answer them successfully. So we usually have a couple of practice questions for you to try out with us live to help reinforce what you've just learned. And then beyond that, that's how it works. You can jump around, watch the whole thing depending on how you're studying. And then at any point, of course, come to school or the Life Health Exam Coach school site and join and then continue studying there. So without further ado, we're going to jump into our first training section. So let's get started. So insurance contracts are a bit different than your standard fare business or personal contracts. And there's specifically 6 different characteristics you're going to learn today that commonly show up on your life and health insurance exam. Again, this is one of the highest yield, highest frequency topics that are discussed because it can be confusing if you're not prepared, but we're going to clarify your confusion so that you are properly ready and in the know on how insurance contracts work and the 6 unique characteristics that, again, commonly show up and make insurance contracts unique. So what we're going to be doing in today's lesson is very simple. We're going to define specifically all 6 contract characteristics and what makes them unique. Again, important information to know for the exam. We'll also identify each characteristic in real world scenarios to take what you learn and see how it applies to the real world of selling insurance. We'll also avoid the most common exam traps, show you how to avoid the differences, say, between aleatory and conditional, adhesion versus unilateral, and then apply these concepts to licensing exam questions with confidence so you can pass the exam and move on with your life. So again, a lot of people miss these questions. That's why it's so important to make sure that you're aware of the definitions and how they apply, more importantly. And you got to be able to distinguish between the concepts. Okay, so it's not just memorization, it's applying what you know and understanding the difference. So like, for example, you very rarely get something like define aleatory, but you do get some scenario-based question, which then offers aleatory amongst the other characteristics as an answer. So you got to know the difference. The exam frequency is all over the board. You will see this, so study very closely and succinctly. So understand insurance contracts, like I said from the outset, aren't like most other contracts. You have situations where you buy a car, you exchange a ton of money for a car, or you sign a lease in exchange for renting a house, or you purchase electronics, something like that. There's negotiated terms that go along with those contracts. I'm going to pay this amount, or I'm going to get this interest rate that's negotiable. Whereas insurance contracts have 6 legal and unique characteristics that literally set them apart from every other contract type. And understanding these 6 characteristics is pivotal. So here are the 6 unique characteristics. We're gonna go in detail on all 6 of them, but we're gonna kind of show you under the hood to start what they are. So aleatory means unequal exchange of value. Adhesion means take it or leave it. Unilateral means only the insurer makes a promise. Conditional means coverage depends on conditions. Personal means based on the insured. And utmost good faith is a concept that requires honest and disclosure in the process of taking out the insurance policy. So let's dig in further. So an aleatory contract is one in which the exchange of value is unequal because performance depends on a future uncertain date. In other words, you pay a premium as the insured. That covered loss occurs or it doesn't. And you either are going to get a large benefit paid, like, for example, if you have a home disaster, right, and you get a huge check cut to recover from the losses, or you just pay this premium the rest of your life and there's never a claim. And both are legally valid. So the point is that with an aleatory contract, the idea is that you may pay a premium for a very long time, and it may be an unequal exchange of value because of the nature of insurance. That's how it has to work. Okay, so the way to remember this is small premiums equal a big possibility with an unequal exchange. That means aleatory. So in action, here's how it looks. Sarah pays $45 a month for her life insurance plan. She dies 6 months later. Her total of premiums paid was $270, and her beneficiary receives $500,000. So was this exchange equal? No. And that's exactly what makes insurance aleatory. The exchange depends on an uncertain future event, not equal dollars. Okay, so very important exam tip. If the question mentions unequal exchange or chance, immediately think aleatory. And this is one, again, that shows up a lot on the exam. So again, unequal exchange, think aleatory. Now, an adhesion contract is drafted entirely by one party, and that applicant cannot negotiate most policy language. So again, you notice the applicant doesn't render or negotiate the terms. The insurance policy is drafted by the insurer, presented to the applicant based on what they determine. And then for the prospect or the client, they either accept it or walk away. So one way to think about an adhesion contract is take it or leave it. So when you look at the exam, if the policy language is ambiguous or courts interpret it against the insurance company and in favor of the insured. So what happens is if it's just not clear, they typically are going to favor the insured and not the insured. This is one of the most commonly tested applications of adhesion contracts, so just remember that, okay? In other words, adhesion contract is where the insurer wrote it, you didn't negotiate it. It's either take what the insurance company gives you or just leave it all together. A unilateral contract means only one party makes a legally enforceable promise, and that's the insurance company. So here's how we kind of contrast the difference. So on the left here, the policy owner, they can stop paying premiums they want. The policy may lapse, and there's no legal penalty for that happening. So there's no enforceable promise that the policy owner has to do in order to have the insurance. Now, the insurance company must pay covered claims as long as the conditions are satisfied and they're legally bound to perform. So they make an enforceable promise. So in a unilateral contract, in short, there's only one promise made and from only one party, the insurer, and the promise is to protect if in case something happens where the product would cover that event. Very commonly in the exam, and again, what you want to look for is only one party language on the exam. That's typically an indication that this is a unilateral contract. Now, a conditional contract, we kind of hinted at that a moment ago, is identifying coverage that depends on a certain condition being met or certain conditions being met. If a policy condition isn't satisfied, the benefits may not be payable. So here are some conditions to the insurance contract. If premiums are paid, well, that condition has been met. If policy provisions have been followed, then that condition has been met. So policy provision may be something like in a life insurance exam, or a life insurance policy, you suicided. Then if you did that within the first 2 years, that has not been followed, so the conditions haven't been met to pay out. Many life insurance plans don't pay out in the form of suicide. Required given notice given, things like this, that you may lose your coverage, it may lapse. Proof of loss submitted, so the condition to pay out is that you can show that proof of loss actually occurred. And then cooperation during investigation. So the company is investigating the claim request to make sure it's legitimate and according to the policy, and you must cooperate as part of the condition. And if all of those conditions are met, then the benefits are payable. Okay. So remember, the best way to think about this and for the exam is that coverage is conditional, not automatic. You have to meet a certain number of criteria along the way to have a policy pay proceeds and benefits. So watch for scenarios where a claim is denied due to a missed condition. So this is something that comes up a lot on the exams. A personal contract is where the insurer underwrites you, not somebody else. Insurance is based on the specific characteristics of the insured person. So the process or timeline is that the applicant applies for coverage, then an underwriting evaluation is completed, the approved policy is issued, and you cannot truly transfer that or freely transfer that to whomever it is you wish. It's your policy. It's a personal contract. So insurance contracts generally cannot be assigned to another person without the insurer's consent. And that's because the insurer evaluated you specifically, your health, your risk, and your profile. So the act of insuring you is dependent on you at the time of underwriting. And that's why you can't contract or necessarily transfer it to somebody else. So in short, because the insurer underwrites you, that is a way to think about the policy being a personal contract. So look for questions about policy assignment or transfer. This is going to be an indication that they're referencing why you can't do that is because it's a personal contract. Utmost good faith refers to both parties dealing with each other honestly and disclosing all material facts. Material facts are facts that would affect the insurer's underwriting decision. So things like, I had that heart attack yesterday versus, I only walked 10 steps yesterday instead of my normal 100. These are dismissible things or immaterial. And then there are material facts, right? So we operate in good faith on the basis of applying for coverage. And it's not just you, the insured or potentially insured, it's also the insurer as well. Both parties must act in utmost good faith. So the applicant truthfully discloses material facts. Then the insured goes through a fair underwriting decision. And then the goal is to, of course, have fair claims handling as well. So a couple of things to remember here. Applicants must answer truthfully. Disclose material facts. Okay, the material means relevant facts to the coverage and applying for it. Insurers must act fairly, honor policy promises, and handle claims in good faith. So both parties, full honesty, and material facts matter. So on the exam, look for misrepresentation and concealment questions that test this concept, okay? Because again, if you have misrepresentation, and we'll talk about more of this in another training, misrepresentation concealment is not acting in utmost good faith. So again, here's some kind of terminology we've covered, and I like to call these the exam traps, because this is where we'll try to switch these terms up on you and try to one-up you, so you got to be prepared. So as a reminder, remember, aleatory describes how value is exchanged. It's an unequal exchange, right? Depends on chance. You dying of something, right, in a certain period of time. You may pay little and receive a lot, or pay for years and get nothing. So aleatory means an unequal exchange of value. Conditional means and describes when the insurer must perform. So it's a function of when it will perform its duties. So, for example, benefits depend on policy premiums or policy requirements being met, like premiums paid, proof of loss, and coverage depends on those conditions. So you have these policies in effect, and it's conditionally going to pay out if those conditions are met. So the trap would be both involve uncertainty, right? Because, are the conditions going to be met? But they describe different things. Aleatory, again, is the exchange of value. Condition means the requirements to receive benefits, all right? So this is always confused on the exam in my experience. Know the difference. Aleatory and an equal exchange. Conditional is receiving benefits when the conditions are met. Another exam trap is adhesion versus unilateral. Remember, adhesion is about who wrote the contract, and unilateral is about who made the enforceable promise. So who wrote the contract, of course, is always the insurer. They drafted it. You as the applicant have no negotiating power. And then if there's ambiguous language, it's always interpreted usually against the insurer. And the contract drafting is done on the side of the insurer. So adhesion, again, who wrote the contract? The insurer. Unilateral is about who is only the insurer is legally bound to perform, about who made the enforceable promise. The policy owner can stop payment. There's no legal penalty, and there's no contract obligations on their side, but there is on the other side. So there's a unilateral approach to the contract. So here's the thing. The adhesion and unilateral both involve the insurer, but they describe different aspects of the contract. Again, they're separate characteristics of the contract. So in short, adhesion discusses who wrote the policy, the insurer. Unilateral discusses who promised to perform, and that's the insurer. So again, tested a lot, cold. And then personal versus utmost good faith. Personal is about who is insured. Coverage is tied to a specific insured that cannot transfer freely the policy to another person. The insurer has evaluated this specific individual. So because it's personal, it's about who is insured, the individual person. Utmost good faith is more about the behavior behind acting out the policy. And in short, utmost good faith is about parties acting honestly in their endeavors to apply for coverage and get and do fair underwriting and follow through in the claims process. Okay. So again, utmost good faith is about behavior. Personal is about who is contracted. Okay. Again, very common. So let's talk about some questions here that will help clear up some of this. An applicant pays premiums faithfully for 25 years and never files a claim. Which contract characteristic explains why this is a fair and legally valid contract? Well, it's aleatory. Okay. Why? Because there's an unequal exchange of value. There was a promise that whole time that would be paid. And after the client faithfully paid for 25 years, it's an unequal exchange. Okay. So remember, because of that unequal exchange, that is what makes it aleatory. So again, this is kind of a summation of everything we talked about. Adhesion, aleatory, unilateral, conditional, personal, utmost good faith. Remember, download the slides at our school Life Health Exam Coach website. Link in the description box below. You can get this and just study the policy language here that's likely to show up on the exam. So some more practice exams just to test your knowledge so far. Which contract characteristic means only one party makes an enforceable promise? That's unilateral. Remember, unilateral means one party. Uni means one, and that one party is the insured. Okay, insurer, excuse me. They promise to make the claims. Okay, policy owner has no legal requirement to pay the premiums. A policy owner pays premiums for many years but never files a claim. Which contract characteristic best explains why this is valid? That's aleatory. Again, an unequal exchange that occurred. Question 3, which characteristic describes a contract prepared by one party with little or no opportunity for negotiation on the other side, other party. Well, that's a adhesion contract. Again, the company presents the terms as is, and you take it or leave it. Okay. Question 4, the insurer denies a claim because the policy owner failed to pay required premiums. Which contract characteristic is illustrated? That is B, conditional, because the conditions to having the policy in effect were payments of premiums. And if that doesn't happen, you don't need to pay a claim. When an applicant transfers or attempts to transfer their life insurance policy to a friend without notifying the insurer refuses the honor of the transfer. That is a personal contract characteristic because the policy itself is personal. It's based off of you and your health, and you can't transfer it because of that. And then applicant 6 here, for wrap it up, an applicant fails to disclose a pre-existing condition on their life insurance application. What contract characteristic did the applicant violate? The answer is D, utmost good faith. And that means, again, both parties must honestly disclose all material facts. And having a heart attack, or heart condition is material to taking out a life insurance exam or a life insurance policy. Okay. So these are the final exam strategies to remember. Again, identify the keywords listed below. Ask the right questions. Who wrote the contract is about adhesion. Who makes the promise refers to unilateral. Who is insured refers to personal. How is value exchanged is an aleatory reference. What conditions must apply as conditional. And last but not least, how must parties behave? Behavior means utmost good faith. Okay. So that's it. Study, grab those slides at Life Health Exam Coach at school below, and we'll see you on the next one. So in addition to knowing the 6 characteristics of an insurance contract, check out our last training on that. You need to know what makes an insurance contract different, because that is the foundation of every insurance policy, and you better believe they're going to test you on it in your upcoming licensing exam. So my name is Dave Duford, and today we're going to go into a deep dive on what makes insurance contracts different. And the more that you master this knowledge here, the better you're going to do, because the content in the following training is very frequent on your exam. So it's critical to understand, again, how an insurance contract is defined in legal terms, explaining why an insurance contract differs from ordinary contracts. You need to also, and we'll learn, how to identify 2 primary parties to every insurance contract, explain the purpose of insurance and how risk pooling works, and then last but not least, recognize and apply the 6 unique characteristics of insurance contracts. So keep in mind, the exam writers who actually created this content, they are trying to test these objectives by describing a scenario. So they're going to lead in their questions on a scenario basis and ask you to identify the correct legal term, party, or characteristic. So don't expect some sort of what is a contract type of question. They're going to say, hey, this aleatory contract, what is the difference between that and then a unilateral contract? So they're going to expect you to understand the differences, but also explain them as well as the definitions, but then explain the differences. So this is what we're going to try to focus on as we talk about the content today, is giving you the fundamental understandings, but then apply it, test your knowledge with quizzes so you can develop, again, a second layer understanding of the material so you can have a better chance of passing. So one of the key concepts to understand with an insurance contract is you're really not buying insurance. You're actually buying a legal promise, okay? So most students think they're purchasing protection, but from a legal standpoint, what's really happening is you're purchasing the insurer's promise to perform if a covered loss occurs. Very important. You'll probably be tested on that, okay? So again, the legal definition is that the insurer's legally enforceable promise is to pay the covered losses. It's not that they guarantee to make a payment of any kind. Again, a covered loss, we're going to get more into that later too. A covered loss means something that's stated in their policy that they should cover. So in plain English, when you buy a car, you drive it home. When you buy insurance, you take home a piece of paper that says, yeah, we'll help you if something bad happens, okay? And that is your legal promise, okay? So you pay a premium, the insurer makes a legal promise, the coverage activates immediately. Okay, so you buy a promise, not protection. So what exactly is a contract? So the legal definition of a contract is that it's a legally enforceable agreement between 2 or more competent parties that creates legally binding rights and obligations. So a lot of descriptors there to go into more detail, because we have to kind of pull that apart, because there's different layers that make a contract valid or not. So in other words, a contract is a deal but the court will enforce. Okay. So both sides have to hold up their end of the deal, or they may face legal consequences. So, in short, contracts are legally enforceable. They require two or more parties, and in exchange have binding rights and obligations. So, if there's no agreement in place, there's no contract. If there's no competent parties, there's no contract. So, the exam is going to test you whether you can identify what makes a contract legally valid, not just what a contract is. And we'll get into some questions that help clarify that in a minute. So, and this is kind of the deal with an insurance contract kind of taken to the next level. An insurance contract is a legally enforceable agreement which the policy owner pays premiums and makes required representations, meaning statements about who they are and what they are in part of the underwriting process. And in exchange, the insurance company accepts the risk and promises to pay a covered claim per the policy terms. Okay. So the policy owner is the one that, of course, pays premiums, makes the required representations about themselves and how they're applying for coverage in an utmost faithful way, receives contractual rights, and then may name beneficiaries. And in exchange, the insurance company issues the contract, assumes a contractual obligation to pay covered losses, promises to pay the covered claims, and then they're bound by the policy terms. So again, the policy owner transfers financial risk. So that's what a policy owner does when they buy a policy, is they're looking to rid themselves or reduce financial risk associated with whatever they're buying the insurance for. And that insurer assumes the risk. So insurance transfers the financial consequences of a covered loss. They're not going to actually cover the physical loss, but the actual financial consequences. It's important to understand that distinction. So why is insurance different from any other purchase? So like, for example, if you buy a TV, you pay money, you get it immediately, and the transaction's over and done with. But with insurance, you pay premium, you receive a legal promise, that's the good that's received, and that you may never file a claim. You can pay it forever and may never use it, okay? In other words, you may never use what you paid for. And that, in certain, is what makes insurance legally unique. And that's why it has its own set of contract rules, okay? So if you buy a TV or a car or anything, you get the TV, okay? With insurance, you get the promise, but you may not actually get the delivery on the promise because there was never a claim filed. And that's actually what we want. You don't want to file a claim. You want to avoid financial loss, okay? So insurance is the only purchase where not using it is the best outcome. Kind of ironic if you think about it in that way. Like most of the time we buy things because we want something immediately from them. With insurance, it's like you may never use it, but you're going to pay all these premiums for it. You know, it's hard. Some people hard to wrap their heads around. Exam writers love to test whether students understand that insurance is a conditional promise, okay, not a guaranteed exchange. So again, insurance is conditional, a conditional promise, not a guaranteed exchange. Watch for answers that say insurance guarantees a benefit. That's never the case. The exam will test whether you understand that insurance is a promise, not a guaranteed exchange value. So why does insurance exist in the first place? To kind of give you some conceptual understanding. So it's the power of risk pooling, okay? So insurance works because risk, the potential that you may suffer a financial consequence, it exists. And you holding that and bearing that risk alone is tremendously risky. So by spreading it across a large group or a pool of people, what happens is that allows the collection of policy owners pooled together to cover that loss, so that despite how catastrophic it can be for one person, through the payment of premiums, it can offset the impact dramatically than if you didn't have it. So many policy owners pay premiums. So thousands of people pay small, predictable premiums. They flow into a pool or a shared risk pool. The actuaries, those are the guys behind the scenes that calculate the potential for bad things happening. And they're statisticians that predict how many claims will occur. And then the policy pool covers the losses of the few who actually have to go through it. So the way to think about this, just in plain English, is if there's 1,000 neighbors putting $500 or $500 into a jar, if your house burns down, the jar pays to rebuild it. Nobody can predict when the house burns, but everybody's covered, right? So that promise of coverage because of the putting the money into the jar is what makes it win, okay? So many pay small amounts, few collect large amounts. That's essentially the definition of insurance. And the math works because losses are predictable across large groups, the law of large numbers, okay? The exam may ask what makes insurance financially viable? And the way to look at that and the answer is risk pooling. Okay. So risk pooling, spreading losses across many policy owners. That's what makes insurance a thing that actually works. So in other words, we kind of went through this, so I'll jump over it. But if you have 1,000 people paying premiums, only 5% actually experience a covered loss. The 1,000 covers the few. The pooling effect disseminates and levels out the huge financial impact just one person can get. And this is why, again, premiums have to be calculated so carefully. If you're in a situation where too many people file claims and or the premiums are too low, then the pool runs dry and it loses for everybody. Okay. So the exam writers are going to test you by asking what happens when the pool is too small, premiums are too low, or too many people file claims. The answer always comes back to what we call actuarial soundness, and that pool must be large enough to be statistically predictable. Okay. So risk pooling, in short, is spreading costs of the few across the premiums of many. Okay. And again, insurance does not guarantee every policy owner is going to check out or collect. Okay. So let's talk about financial risk versus physical risk. Now, this distinction appears, again, on almost every state exam. So some things that insurance can and cannot do. Insurance cannot restore your health, bring you back to life, rebuild your home, and it can't undo the physical event itself. But what insurance can do is compensate for loss, medical expenses, provide a death benefit to survivors, pay to rebuild or replace property, and basically replace the financial consequences of a covered loss. Okay. So insurance, in other words, in short, transfers the financial consequences of a covered loss, but not the physical loss itself. You can't get back the loss, but you can financially compensate for it. And that's where insurance covers it. Okay. So in short, a physical loss will always happen. That doesn't change. But what the insurance does is cover the financial loss associated with the physical loss. Okay. So on the exam, if an answer choice says insurance transfers or replaces the physical loss, that's wrong. Insurance only transfers the financial consequences. Okay. So why are these 6 characteristics and why do they matter on the exam? Again, we're going to go into them in just a minute. They appear in every section. They explain policy language. They're tested directly. So we see this apply a bunch of the times. So that's why we cover it in this one. We also have a separate training that covers this in detail, but it's worth mentioning again here because it's just so common that you need to know how all this stuff works, right? So again, you'll never really run into questions that are just going to ask you, what's the definition of valuatory? They're going to describe a scenario and then ask you to answer it based off of how the scenario is designed. Okay. So you will see questions that describe a scenario and ask which contract characteristic it illustrates. Again, you want to know not just the definitions, but how it's applied. Very important. Okay. So the 6 unique characteristics of insurance contracts are aleatory, which is an unequal exchange of value. So you may pay a premium for the rest of your life and never file a claim, and that's actually a good thing. That's an unequal exchange of value, or you may do premium payments for 2 months, die, and your beneficiary gets $1 million. That's also an unequal exchange of value. So the nature of insurance contracts is they're unequal in the exchange and therefore aleatory. They're contracts of adhesion written by the insurer and accepted or rejected as is. So adhesion means who wrote the contract, and it's the insurer. They are conditional, meaning they only pay if certain set of conditions are made regarding premium payments, policy provisions, etc. They're personal in nature, which means the insured cannot assign or transfer the policy to somebody else because the nature of the policy is based off of the individual's health at the time of application. They're unilateral, and so that just means that the insurance company is the only ones that have a binding promise or a legally enforceable promise to pay, whereas the individual can decide to pay or not. Of course, those conditions aren't met, then you don't have necessarily a conditional contract that will pay anymore. But you get the idea. The promise is made by the insurance company, and that's only legally enforceable at that company level. And all contracts with insurance contracts must be done in utmost good faith. The entirety of insurance depends on people honestly representing the material facts, meaning the truth, with what's going on with their health, the prescriptions they take, and then also the insurance company has a utmost good faith to do their job fairly on underwriting and pay the claim fairly when time comes. Okay. These will show up on every insurance exam. Know them back and forth. Study this exhaustively. Okay. and expect scenario-based questions. So here's some scenario exams. And again, you can watch the full training we did on this separately if you're watching the large version of this previously section, or just look for the aleatory contract terms and then study it that way. So real exam scenario, did the insurer fail? In this example, a client pays 30 years and never files a claim. The question to you is, did the insurance company fail to fulfill its contractual obligation? The answer is no. Now, why is that the case? They've been paying a claim all these years and didn't get anything out of it. Well, you have to understand insurance is aleatory. It's an equal exchange. What you bought, or the client bought, was a promise to pay, okay, under covered losses, which were never met. So again, the obligation is to provide coverage, not a guaranteed claim payout. The insurer fulfilled its promise by maintaining coverage for those 30 years. And because no covered loss occurred, no payment was required, and the policy owner received exactly what was purchased: continuous insurance protection, or a promise to pay financially covered losses for those 30 years. Okay. So students miss this a lot because they confuse insurance with an investment. An investment is something that pays off, right? You sign a contract, you invest in something, the goal is to get something back over time. But with an insurance contract, it's just not like that. You're buying a promise that if something happens, then that's what makes it unequal exchange. So they expect a return on premiums paid. Students do, sometimes clients do too, but that is not the case. Insurance provides protection. Again, that's a key critical concept, not guaranteed payouts. Okay. So paying for insurance and never using it isn't a loss. It's a win, actually. It means you stayed healthy, safe, and alive. The insurer kept its promise the entire time. And the insurer's promise is to cover losses only if they occur. There's no guarantee that it will occur. Okay. This scenario tests the aleatory nature of insurance contracts. Again, it's a value of an equal exchange and depends on chance. Very commonly shows up on the exam. So remember all of the stuff before the exam. Insurance is legally enforceable, not a guarantee of payment. Insurance transfers the financial consequences of a covered loss, not the physical loss itself. Insurance contracts follow special legal rules that make them different from ordinary contracts. Risk pooling allows many policy owners to fund the covered losses of a few. And the six unique characteristics that we learned previously of insurance contracts appear again and again and again in all 50 states insurance exams. Before moving to the next lesson, again, the key thing is to understand, what does insurance transfer? What do policy owners receive at purchase? And what makes insurance financially viable? Know those back and forth. Review the slides, rewind in the training. We mentioned all of this. Very important that you understand it, okay? So some exam questions to kind of test your knowledge. So which statement best describes an insurance contract, okay? A savings account that earns interest. A legally enforceable agreement transferring financial risk from the policy owner to the insured. A guarantee to the policy owner will receive more money than paid premiums. A government-backed financial investment program. The answer is B, and B is the answer. A legally enforceable agreement transferring financial risk from the policy to the insurer, okay? Insurance is never a savings account, okay? Premiums are not invested, okay? So if you see anything that suggests that insurance is an investment, it's not, okay? Insurance does not guarantee a profit or a payout, okay? So anytime you see that suggested, that's not the answer, okay? And most insurance contracts are private agreements between the policy owner and private insurer, not government investments. So in short, insurance is a legally enforceable promise to transfer financial risk. That's the definition and the answer, okay? All right. Very common. There's the slides if you want to review them again. What type of risk does insurance primarily transfer? Is it emotional, physical risk, financial, or moral? The answer, of course, is C, financial risk. Remember, moral, emotions, can't transfer those. Physical damage you can't transfer. It's always financial, okay? So we're just going to bounce through this real quick. What does the policy owner receive immediately after purchasing insurance? Do they receive a guaranteed claim payment equal to the policy face amount? Ownership rights to the insurance company? A legally enforced promise of coverage under the policy terms, or a full refund of premiums if no claims occurred during the policy year? Again, very simple concept here. C, the answer is a legally enforceable promise of coverage until the policy terms, okay? Claims are only paid for covered losses that actually occur. There's no guaranteed payment, right? Policy and shareholders are separate roles. Buying a policy does not create ownership. Okay. It's just an insurance contract. And most policies do not refund premiums simply because no claim occurs. Some do, but most don't. Okay. And if that is the case, that's a separate and unique situation. Premiums are the cost of the coverage promise, not a deposit. In today's training, we're going to talk about the 5 elements of a valid insurance contract. Again, there are legal requirements that every insurance policy must meet. We're going to go into detail on what those are so that you can be prepared to pass the life and health insurance exam. Very important. So what you're going to be able to learn or will learn after this lesson includes identifying, again, those 5 elements of a valid contract. You'll recognize common exam traps involving contract validity. You'll explain why each element is required and then apply these concepts to your actual licensing exam. So hopefully you can pass it as soon as humanly possible. So there are 5 valid contract elements that are required in every single contract. And they are as follows. Of course, this is just kind of preliminary review. We're going to go into detail on each of these in a second. We have what's called the agreement, consideration, competent parties, legal purpose, and insurable interest. And this is very important. Even if one element of these 5 characteristics are missing, the contract may be void or completely unenforceable. Okay, so it's all or nothing in many cases. And this shows up on the exam a ton. So you need to know this information back and forth. So the question to start with is, can you have a signed insurance policy that is not a valid contract? The answer is absolutely yes. A signature does not automatically make a contract legally enforceable. And every contract must satisfy 5 legal requirements before a court will decide to enforce it. And that's what we're going to be learning. So these, again, are the same things that are needed: an agreement, consideration, competent parties, legal purpose, and insurable interest. Now, a side note that's very important: general contract law teaches 4 core contract elements, but with insurance license exams, typically test insurable interest as an additional insurance-specific requirement. Okay, so that's where these 5 different contract requirements come into. And if you need a memory hack, anagram, whatever, ACLI is a way to remember it: agreement, consideration, competent, legal purpose, insurable interest, ACLI. So let's get into the nitty gritty. Number 1 element is agreement, which is offer and acceptance. So an agreement occurs when the applicant makes an offer and the insurance accepts it. Okay, so the timeline on getting a policy typically looks like this: an applicant submits an application, they make the offer. The application is then reviewed by underwriting at the insurance company. Then the insurance company evaluates the risk, approves it or denies it. They make an underwriting decision. And then the policy is issued, assuming everything worked out. And it's generally complete following the underwriting approval. So the applicant, and this is important for the exam, they're the ones that make the offer. Okay, it's the insurance company that accepts their offer. All right, so students commonly get it reversed. They think the insurance company makes an offer. No, it's the application, the applicant using their application making the offer to underwrite them for insurance. Okay, so think agreements and offers come from the applicant, not the insurance company. Number 2 is consideration. So consideration basically means each party must give something of legal value to make the contract legitimate. So, for example, what does the applicant provide for consideration? Premium or a future promise to pay. And then along with that, of course, utmost faith, truthful application statements. And then in exchange of consideration, the insurance company provides a legally enforceable promise to pay covered claims. Okay. And again, if you don't have consideration, premium, truthful application statements, you don't have a contract. Okay. It makes it unenforceable. Number 3 is competent parties. So again, just because you can sign a contract doesn't mean you understand it or have sound mind. So a couple of things come to mind here is most common: legal age issues. If you don't meet minimum age, you can't enter contracts. Mental capacity. If somebody's mentally incompetent at the time of signing, a lot of reasons why that may happen. It may not be of sound mind enough to sign a contract. And last is the ability to understand the agreement. So this is more mental, mental capacity. to understand the agreement. All right. So, for example, minors and the mentally incompetent individuals may lack legal capacity. This is where a contract may become voidable or unenforceable. Element 4 is legal purpose. So, you may have all the other elements of a contract, but if you're doing something illegal like selling drugs or doing something nefarious that is not bound by law, uh, it doesn't make it a valid contract. Okay, you're not going to go to your court and ask the judge to enforce your drug dealing contract, right? Not going to have it. So insurance exists to protect against legitimate financial loss, not to encourage illegal acts. Okay. So a valid form, of course, is insurance purchase to protect legitimate financial loss. An invalid purchase for insurance is to facilitate illegal activity. Okay. Number 5 is insurable interest. So let's explain this. It's a little different. It's what makes insurance unique. A policy owner must have a financial loss or certain close family relationships recognized by law if the insured dies or experiences the covered loss. So the way this looks is an insurable interest is like family, or business partners or creditors or employers. Okay. You don't want, there used to be a term called stranger owned life insurance. You don't want strangers to own life insurance on you because they don't love you and they may want to, in order to collect on the benefits. So that's the idea behind insurable interest is to prevent these type of policies which encourage nefarious and thus illegal activities. So for life insurance, insurable interest generally must exist at policy issue, but not necessarily at the time of the insured's death. So understand that's a function of the time at the time of taking the policy out where insurable interest is very, very important. Okay. So how it all fits together, it looks like this. The offer, which the applicant does, proposes insurance terms. The acceptance is the insurer agrees to the offer. The consideration is premium paid or a promise exchange and a promise exchange. And it must be valid with competence, purpose, and interest confirmed. And there must be an insurable interest too as well. So again, which elements are missing here? A minor applies for insurance. That's a competent party issue. A policy on a complete stranger. That's insurable interest issue. There's no premium or promise exchange. Well, that's a lack of consideration. The contract requires illegal activity or it lacks a legal purpose. And the insurer never accepts the application. Well, then that's a lack of agreement. Okay. So again, these are again where the definition is applied, and some of these test questions we'll get here in a second will test you on this so you can see it in action. So what's missing here? We got agreement, consideration, competent parties, and insurable interest. Well, what's missing is a legal reason. Okay. So if you don't have that legal reason, like we talked about earlier, you don't have a legal purpose. You don't have a contract for insurance. So again, real exam life insurance scenario. John applies for life insurance on a complete stranger because he hopes to collect the death benefit. The insurer accidentally issues a policy. Is the contract valid? No, so it won't pay. Okay. So again, every issued policy isn't valid. Mistakes can be made. So we have to follow these 5 principles discussed. Okay. So exam cheat sheet. Again, you can download these slides at Life Health Exam Coach school site. Links in the description box. And then have this to practice on as you go. This is a very useful tool to help you memorize and understand how these 5 concepts work with contracts. All right, in today's video, we're going to do a little deeper dive on competent parties and legal purpose to help you understand, again, the important 2 distinct requirements of an insurance contract a little bit more in detail. Our previous training covers that on the surface, but this goes a little bit deeper because it does show up on the exam a lot. We really want to just make sure this is 100% clear. So the goal of this training is to first define competent parties and legal capacity, distinguish void versus voidable contracts, identify who may lack legal competency or legal capacity, explain the legal purpose requirements and insurable interest connection, recognize and avoid common exam traps. So again, not everybody can enter a valid contract. If you're a 10-year-old signing a $5 million life insurance policy, it doesn't necessarily mean that's going to be an enforceable contract, even if the policy is issued. Okay. The law requires 2 things beyond a signature: competent parties. Both parties have to have legal capacity, and lawful legal purpose. All right. If you don't have those, you don't have a valid contract. And they appear all over the exam. So make sure you understand that. So signing a contract doesn't always make it valid either. Just because an invalid, lacking of the 5 characteristics contract is presented and you sign it doesn't mean that those 5 elements of the contract, even if one other one was missing, doesn't mean that that contract is valid. Okay. So we'll ask questions like, were two competent parties signing it? Was the legal purpose understood? And is it lawful? And then at that point, it is enforceable. So what are the legal parties or competent parties? So mental capacity. So they've got to understand the nature, rights, and obligations of the agreement. They have to have legal authority. So they have to meet minimum legal requirements to sign a contract, and they have the ability. Okay. So applies to both individuals as well. Like you may have an insurance company that issues a policy that they're not in a state of. They don't necessarily have the ability to initiate that policy, right? So it makes the contract invalid. So who may lack legal capacity? Well, people like minors, mentally incompetent, court declared incompetence. These are the ones that are going to potentially void the application and not make it a binding contract. So void versus voidable contracts, let's talk about that. Void does not necessarily mean voidable. There is a difference, okay? So when we see a void contract, that means it was never legally valid from the start. It cannot be ratified or enforced by either party. And so something like an illegal purpose contract, right? A contract to do drugs, that's a void contract. It's not enforceable, okay? Whereas a voidable contract is valid and enforceable until one party rescinds it, and the party lacking capacity may affirm or void it. And that could be someone like a contract entered into by a minor. But again, it's void, it's valid and enforceable until the other party rescinds it under these express conditions, okay? This distinction appears, again, on every licensing exam that we've seen. Know the difference cold, okay? Void versus voidable. As far as minors and insurance contracts, okay, minors contracts aren't generally voidable. Minor contracts are generally voidable, not automatically void. So a minor may be able to own certain insurance policies, exercise rights, and affirm the contract upon reaching legal age. But a minor generally cannot enter a fully binding contract without capacity or be held to a contract they chose to void. And they cannot waive the right to disaffirm before reaching majority, okay? So this is one of those things where you may want to do a little more digging into your state and what your pre-licensing examination discusses about contracts. It might differ between state to state. Make sure that you understand that, okay? Bottom line, that when a minor appears in question, immediately think voidable, okay? It's void if it's illegal, voidable if it's a minor. So legal capacity for mental competency. In order to enter a valid contract, the person must be able to understand what they're agreeing to. So you are considered have mental capacity and competency if you can understand the nature of the agreement, understand the rights being received, understand the obligations accepted, and you can make a rational, informed decision. Now, you lack capacity generally if you're unable to understand the agreement. The contract may be voidable or void. The court declaration of incompetence generally means it's void. And say if you're drunk and you're intoxicated, high at the time of signing, that may also affect capacity too as well, okay? So mental incompetence at time of contracting does not necessarily mean court declared legal incompetence. Court declaration generally means void. Situational incompetence may be voidable. Again, the drinking intoxication point, okay? So again, capacity means understanding. No understanding means no valid contract. Okay, remember that to help kind of understand the difference. So same thing with insurance companies. They're competent parties too. You need legal capacity on both sides of the deal. Like we said earlier, you need to be an authorized insurer in the state. If you're not, you don't have legal capacity. You need to be legally permitted to issue insurance contracts. If you are an unauthorized insurer, if you lack legal authority to transact insurance in that state. And so it's not just a individual person thing, and maybe the insurance company as well. And you got to have a legal purpose, like we said. It's got to be lawful. It needs to serve a lawful objective. If it doesn't, it's void and unenforceable, no matter the capacity of the individuals involved, okay? So again, a legitimate example is purchasing life insurance to protect your family's financial security in the event of your death. That provides a legitimate insurable interest, or protects a legitimate insurable interest. If you purchase insurance on a stranger with no insurable interest, hoping to profit from their death, that does not follow the contract law associated with insurance, so it's void. So, for a real life example here, Tom purchases life insurance on a stranger who's never met with no financial relationship, hoping to profit if the person dies. Is it a valid insurance contract? No, because there's no insurable interest, right? It's a stranger, and there's no legal purpose. You can't, that's not a legal reason to buy a policy, right? The hope that they die. Okay. So this scenario violates both insurable interest and legal purpose. Okay. The exam may ask about either. So both apply there and make sure you understand them. So save this sheet here to look through the differences here on all the different aspects. These are just some short keywords that are very helpful in helping you like memory check where you're at. Remember, you can download these slides at school. Look for a life health exam coach or just follow the link in the description box below. So if you put it all together, this is how it's looking. If both are present above, then the contract is valid and enforceable. So, for example, competent parties with a legal purpose, then it's enforceable. If there's one or the other missing, it's either void or voidable, no matter if it's already signed. Okay. So again, here's the 4 rules to lock in about our topic today. First, legal capacity is required on both sides. The applicant and the insured need it. Minor contracts are generally voidable, but not necessarily void. Insurance laws vary by state, so double check on that. Mental incompetence does not necessarily need court-declared incompetence. One may be voidable, the other void. Think drinking or being high or intoxicated, okay? Insurance contracts must serve a lawful purpose protecting legitimate insurable interest. No wagering, no legal objections or objectives or anything like that, okay? So again, test yourself on these practices. We'll let you do this on your own. You can download these slides. Here are the actual practice exams. Which contract element requires both parties have legal ability to enter an agreement? The answer is C, competent parties. Again, the legal ability typically means the competent party qualification. Which individual is most likely to lack the legal capacity to enter a binding insurance contract? The answer is C, a person who's been legally declared mentally incompetent. They don't have the capacity to enter a contract. And then why must every insurance contract have a legal purpose? And that is to ensure the agreement complies with the law and protects legitimate insurable interest, okay? In today's training, we're going to learn what consideration is and what each party must create or give to have a valid insurance contract. A very common question related to considerations are asked on the insurance exam, so you want to make sure you know this stuff cold. So the end of this lesson, you're going to be able to define what consideration is in context of insurance contracts, identify exactly what the applicant provides as consideration, also identify exactly what the insurer provides as consideration, and then last but not least, you'll be able to spot and avoid the most common exam traps and apply consideration concepts to real licensing exam scenarios. So let's begin. So every valid insurance contract requires an exchange, okay? So essentially entering into a contract, the two parties have to exchange something in order to validate the contract. So in this case, what the applicant gives is money, okay, as well as required representations that are truthful, meaning statements they've made about their health in the application. In exchange, the insurer gives legally enforceable promises to pay covered claims and a promise of coverage. This exchange is consideration. So most people say that insurance companies sell insurance, but again, it's important to understand legally, you're selling a promise. It's a legally enforceable promise to pay for covered claims. It's not an immediate payment, but it's a binding, legally enforceable promise to pay covered claims, okay? So what your premium is buying is the insurer's promise. That's their consideration, in other words, okay? So again, definition of consideration, the applicant gives the premium, the insurer gives legal enforceable promise to pay covered claims. That's your consideration. And so understand that a little bit further than this is that what consideration is not is simply signing the application. There's still more conditions that have to be met to make that contract valid. You can't just name the beneficiary even after signing it and die and expect them to get the money if you haven't met the other conditions of policy, generally speaking, going through underwriting, and then also paying the first premium. And then receiving the policy, can still receive the policy with all of the above done, but not yet have paid the premium yet to complete the consideration aspect, okay? So the way to think about the application is the vehicle through which the required representations are made, but signing it alone is not consideration, all right? So a premium plus required representations is what is required to have consideration. Okay, but you can have one or the other too. The insurer is selling a legally enforceable promise, not an immediate payment. So on the flip side, the insurer's consideration is not paying a future claim, conducting a medical exam, or approving every application. There's a bunch of steps they got to go through before their side of the deal is done, as well as yours too. So again, the premiums are exchanged, the consideration is exchanged, and both parties have exchanged legal value, and now the consideration exists, okay? So the applicant submits the application with required representations and pays a premium. In exchange, the insurer issues the policy, makes it legally enforceable, promises to pay, and that value exchange for consideration is done. So some common test traps here just to be aware of. Trap number one is the insurer's consideration is paying claims. And trap number two, the applicant's consideration is signing the application. Okay, so that is not the case. All right, we'll show you why. First of all, the insurance company's consideration is paying a future claim. The reason it's not is because the insurer's consideration is legally enforceable promise to pay covered claims. So it's the promise that the insurance company makes, not the claim payment. Okay, the promise exists from day one. The claim payment may never happen. That's why it's not promised. Okay, that's why the promise is the consideration. Exam trap number two, the applicant's consideration is signing the application. We know now that you'd have a required premium to pay plus required representations made in the application for it to be consideration. So signing's not enough. Okay. This is an example that just goes over what we've described. If you want to pause and review that, where the exchange happens. Again, without consideration, there's no enforceable contract, no legal obligation for the insurer, no enforceable rights for the applicant, and courts may not uphold your agreement for coverage, okay? Because there's no consideration. So some exam scenarios here just to kind of test this concept. Mike completes an insurance application but never pays a required initial premium and no alternative payment arrangement exists. Did the applicant pay the required premium? No. So he never paid it. Were required representation made the application? It was incomplete, yes, but the premium is still missing. And so the result is the applicant has not been provided full consideration. Therefore, a valid contract may not be formed. Okay. So remember, a premium plus required representations equal consideration. So remember, consideration is the exchange of legal value. An applicant's consideration is required premium plus required representations. And an insurer's consideration is legally enforceable promise to pay covered claims, not the actual claim payment itself. Okay. So again, same thing we've seen a couple of times. Review that on your own. Is consideration and premium the same thing? No, because the applicant's consideration is the premium plus the required representations, not just the money alone. Got to represent the underwriting questions essentially and everything else in the application to make it fully consideration. Okay. So again, we'll just jump through this since it's the same thing. Let's get to the mini practice here. An insurance contract consideration refers to A, B, C, or D. The answer is B, the exchange of something legal value between the parties. And that's what makes it a valid contract. Which of the following is the insurance company's consideration? The answer is C, the legally enforceable promise to pay covered claims. And 3 of 3. Which of the following is typically part of the applicant's consideration? The correct answer is A, paying the required premium and providing statements in the application. In today's training, we're going to talk about the offer and the acceptance and covering when an insurance coverage of a policy actually begin. This very likely will show up on your exam. It's one of the most commonly tested portions of it. And by the end of the lesson, the goal is to know exactly who offers, who accepts the coverage, and when it actually begins. So you'll know who the offerer is, explain how the insurer accepts, understand underwriting's role, distinguish between conditional versus binding receipts, determine when coverage becomes effective, and then you'll master these 5 concepts and be able to pass the exam with confidence, okay? So this topic causes thousands of wrong answers, okay? One myth that's common that's wrong is that coverage begins when I submit the application. The reality is that understanding when coverage begins is one of the most tested concepts on the exam, and you need to understand the difference. So who makes the offer for coverage? It's the applicant, not the insurer, okay? The insurer decides whether to accept or reject the applicant's offer. So understand that the applicant submits the application, meaning it makes the offer, and the insurance company reviews and then accepts or rejects it. The application is the offer. That includes signing it, submitting it, offer made or not, underwriting review, insurer decision, and then the policy is issued, and then the coverage is effective, okay? So the point is the application is the offer. That's how to remember it. Submitting the application creates the offer. So that's the act of creating the offer, is the submission of the application, okay? Underwriting is what every application goes through to evaluate the applicant's risk profile. So they're going to ask questions about things like health, medical history, occupation, lifestyle, hazardous activities, financial information. And then the insurance company decides on those material facts to decide if they accept it, modify the coverage with what's known as a counter offer, just decline it outright. So underwriting does not create coverage. It just is a risk evaluation, okay? And then it informs the insurers of their decision, okay? So in other words, underwriting is evaluating the risk. The insurer is asking, should we accept a risk and at what price? So acceptance happens after the contract is formed, and that's when the applicant makes the offer, underwriting reviews, and the insurer accepts, and the conditions are satisfied, therefore the coverage begins. So the applicant offers, and the insurer accepts. Once acceptance occurs and required conditions are satisfied, the insurance contract becomes effective, okay? So if you ask in the scenario on an exam, when is a life insurance contract formed? The answer is when the insurer accepts the policy or accepts the applicant's offer and all required conditions are satisfied, okay? So what if the insurer changes the terms on the policy? Well, that's what we call a counteroffer. So let's say a policy applicant applies for $1 million, but the insurer approves only $500,000, okay? That is a counter offer. And the applicant has to agree to the new terms or just, again, take it or leave it, an adhesive contract. And any change to the original terms by the insurer equals a counter offer, meaning the original offer is rejected and the applicant must accept the new terms if they want coverage to begin. So conditional receipts are very important to understand. A conditional receipt is issued when the applicant pays for the premium with the application. It may provide temporary coverage if conditions are met. So remember, coverage is conditional, not automatic in this case. So it looks like this. The initial premium is paid. The receipt is issued. They still have to answer the question if the applicant meets the conditions. And if it is, the coverage may apply. And if it's no, then there's no coverage and they'll get their money back. A conditional receipt does not guarantee coverage. A coverage depends on satisfying the stated conditions. It's one of the most commonly missed questions. Now, talk briefly about medical examinations. There's a common misconception that coverage begins when a medical exam is completed. That is not the case. It's just an extension of underwriting. Think of it as just a part of the underwriting process to help determine if the individual in question is insurable or not. So when does coverage actually begin for a policy? Well, it depends. So coverage generally begins when the policy is delivered and all required conditions are satisfied, provided no earlier effective date applies under a conditional receipt, okay? Now, if a receipt is issued, then you apply the rules of that specific receipt, okay? So like if it was applied earlier at a specific date, then you can do that. Again, if there's no receipt, then coverage begins at the policy delivery when all required conditions are satisfied and no earlier effective date exists, okay? If it's a conditional receipt, then coverage begins if stated conditions are satisfied. If it's a binding receipt, that just gives immediate temporary coverage, but that's more of a property and casualty thing, not a life and health, okay? So let's say Sarah submits an application, pays the first premium, receives a conditional receipt. 2 days later, she dies in an accident where the policy is formally issued. Will the insurer pay the death benefit? The answer is yes, if Sarah met the conditions required by the conditional receipt. So for example, if she was insurable under the underwriting standards at the time of application, then it would be paid. But it would be not paid if Sarah did not satisfy the conditions stated in the conditional receipt, okay? So students assume paying the premium automatically creates coverage. It doesn't. It's a conditional receipt, which means it creates conditional, not guaranteed coverage, right? So that's a timeline of going from offer to acceptance. And then common exam traps here, which are very likely on the exam. Coverage starts when I submit the application. False. Submitting the application creates the offer, but not necessarily coverage. Paying the premium automatically creates coverage. Is that the case? No. Only if receipt conditions are satisfied. And the medical exam completed means I'm insured, not the case. Underwriting must still determine insurability. And last but not least, insurance company makes the offer. That does not mean you're covered. it's the applicant that usually makes the offer. So it's never the insurance company, it's the applicant. Okay. So here's some mini practice exam questions. In most life insurance transactions, who makes the offer? We should know that it is C, the applicant. The applicant makes the offer to the insurance carrier. If an insurer approves less coverage than the applicant requested, they have made a counter offer, B. Okay. So it means that original offer from the applicant was not accepted. So the insurance made a counter offer. Okay. And then a conditional receipt generally provides coverage only if the stated conditions are satisfied. The correct answer is B. It's conditional. Okay. So these are 7 must-know questions to look at without looking at your notes. So make sure you review this very carefully. Remember, you can go to my school site, Life Health Exam Coach, to download these flashcards, slides, and more to help you study and prepare. And thank you very much. In today's training, we're going to talk about representations and warranties. These are important aspects of insurance contracts that you have to understand in order to pass the life and health insurance exam. So what you're going to learn after this lesson is have the ability to define a representation as well as a warranty, compare their legal significance, recognize the exam traps, and then apply these concepts to real exam scenarios so you can pass it. So understand that every insurance application relies on an applicant's statements, okay? So you have to have utmost good faith. You have to truthfully and materially answer the questions that are posted. And it's important that you do that. But not every question asked is and does carry the same legal weight. On the licensing exam, what you're going to find out, you're going to need to know the difference in kind of what those are, which is a representation versus a warranty and how they're different, okay? And so let me give you an example scenario to kind of explain this. Imagine you were to apply for insurance and estimate, I weigh 198 pounds. But then a week later, the insurer learned you actually weigh 200 pounds. Did you just commit fraud? Is that a fraudulent question that you gave? Well, the answer is no. The statement may just be an honest representation, okay? Insurance applications generally rely on representations, not absolute guarantees, okay? So that's a huge difference. So in other words, a representation is a statement made by an applicant that is true to the best of his or her knowledge and belief at the time it was made. So key things that make up what a representation is an honest statement. It's to the best of the applicant's knowledge and belief, and that's used by insurer during underwriting. Okay, so representation is an honest belief. So common representations discuss or include age, health history, tobacco use, occupation, existing medical conditions, family medical history, and driving history, okay? Because these all influence underwriting decisions with insurance. Now, a warranty is a statement or promise that must be strictly true or fulfilled according to its terms. Warranties commonly used in insurance law in the past, but that is not the case today. What are relied on legally are representations. So on the exam, state licensing exams often emphasize that application statements are generally considered representations, unless this question specifically says otherwise, okay? So representations are the name of the game in the insurance space today. So representations are believed to be true. Warranties must be strictly true or fulfilled. Representations used in most life insurance applications. Warranties less common in modern life and health apps. Representations are incorrect statements evaluated for materiality. Or I should say incorrect statements are evaluated for materiality and traditionally enforced more strictly. So even if it was not strictly true, but it was immaterial, then you may be penalized anyway, okay? So warranty is just an absolute promise, and then a representation is a reasonable belief, okay? So we'll go through this and kind of jump around. So materiality does matter. You may have mentioned that. Not every incorrect statement affects coverage. Was the statement material, meaning did it actually make a difference, right? Like if I didn't answer correctly what I ate yesterday, does that make a big difference in the application? If it does, the insurance may deny or modify coverage. If no, the statement may not affect the policy. So materiality of the answer or the representation makes a big difference, okay? So again, an applicant makes a statement. Was it correct and was it material? If it is material, this may allow the insured to rescind the policy or deny a claim, depending on the applicable state laws and provisions, right? They should not have ever made the insurance policy in the first place is kind of how they look at it. given what they now know is something being material. If it's not material, likely won't significantly affect coverage. Okay. So, in other words, materiality means would this have changed the insurer's decision if they had known about it at the time of application? So, again, representations matter because all of these things are going from start to end, and you have to know representations, and accurate representations are so important from the beginning to the end. Okay. They need them because insurance companies, in designing their products, need to be pricing premiums fairly so they can price out the risk. Also, to detect fraud, stay away from fraud. Classify applicants differently. There's different rating classes depending on the underwriting information and due diligence done, and decide whether or not to issue coverage. You know, a representation not made accurately can affect dramatically whether the policy should have been issued or not. So the way it looks like on exam is like this. If it's an honest statement, it's a representation. If it's absolute promise, it's a warranty. If it affects underwriting, it's materiality. And then if it's an intentional false statement, it's misrepresentation or fraud. So really know those four differences cold. So Sarah answers no when asked if she's ever smoked. In reality, she still qualifies as a tobacco user under the underwriter's guidelines because she smokes a pack a day. Would that matter? Absolutely, because tobacco use typically is a material fact that affects underwriting and premium rates, right? So again, the exam is going to try to trick you and say every incorrect answer is fraud. That is false. Many incorrect statements are simply representations that must be evaluated for materiality intent. So honest mistakes are not fraud necessarily, okay? Every incorrect statement voids the policy. False. The insurer must consider whether the statement was material and what the applicable law and policy provisions provide. So in other words, the insurer must evaluate materiality and applicable law before taking action on any incorrect statement. And another trick is representation and warranties mean exactly the same thing. We know now that's not the case. Representations are honest beliefs. Warranties are guarantees. So here's a real exam scenario. So John accidentally reports his height as 5'11", so 6 foot. The statement on his application is best described as B, a representation because it reflects his honest belief at the time. Okay. So before the exam, remember, most application statements are representations. Representations are judged based on honesty and materiality, and warranties are stricter, but far less common in modern life and health insurance. Okay. Another practice exam, which of the following is most likely considered a representation? The answer is B, an applicant's health history provided on the application. Okay. And most statements made on a life insurance application are B, warranties. We've learned that warranties are, B, representation. Sorry. We've learned they're not warranties because the legal model shifted from that. And endorsements and riders are functions of the policies themselves. What are the primary differences between a representation and a warranty? The answer is B. A warranty generally requires strict truth or performance, while representation reflects an honest statement believed to be true. And last but not least here, I'll read the covered up part here on the screen. An applicant unintentionally gives an incorrect answer that would have affected the insurer's underwriting decision. Which concept is most important in evaluating significance of the statement? Is it A, B, C, or D? And the answer is B. In other words, the insurer evaluates whether the incorrect statement was material, meaning significant to the underwriting decision or not. Okay. All right, and today's topic on insurance contracts to study for the licensing exam for life and health is concealment, misrepresentation, and fraud. You need to identify the difference to all three of these. They will show up on the exam. And in today's lessons, you're going to be able to, number one, define concealment, misrepresentation, and fraud, identify what a material fact is, distinguish harmless mistakes from deceptive intent, and last but not least, apply these concept exam scenarios so hopefully you can pass the thing and get to work and help some people with their insurance. So this is where students lose a lot of easy points, okay? So what rarely happens on exams is just asking the definition question, right? What is concealment, misrepresentation, fraud? What we do see instead is which concept is illustrated in the situation, which term best matches these facts, which is happening in this real world scenario. So you want to be prepared for the second column there, okay? To be able to identify concepts, not just define them, okay? And so this happens a lot, so you got to be prepared. So the first thing to understand is not every answer that's wrong is fraud, okay? So an applicant may say something like, I've never smoked. when in reality, they may have quit smoking 5 years ago. And the question you have to ask yourself is this fraud, concealment, misrepresentation? It depends on intent, materiality, and the specific facts. We don't know based off of just their answer alone. There's a lot of nuance to it that you'll understand and master today. So, from a big picture standpoint, when an insurance company relies on incorrect information, three things may happen, such as information wasn't disclosed. Well, that's concealment. Okay. Incorrect information was provided. That's a misrepresentation. And then three, someone intentionally deceived another party for unlawful gain. That's fraud. Okay. So let's break down the differences between these a little further. So concealment means failure to disclose information. So it was a known material fact that is withheld, so it's known. Okay. It's not ignorant. It's one thing to apply for life insurance and you don't know you have cancer. That's not concealment. If you know you had cancer and applied and didn't disclose it, that's concealment. Understand the difference? Silence or omission. Silence is compliance, right? Lie by omission is kind of the same concept here. Okay. And these may lead to rescission or the cancellation of the policy if found out. Now, misrepresentation is an incorrect statement. It can be intentional or unintentional. So you can intentionally misrepresent, which is fraud. More on that in a second. Or you can unintentionally misrepresent, okay, which is not fraudulent. Either way, it's a wrong answer on the application. It may lead to rescission if the fact was material and vital to whether or not the policy should have been issued. And fraud is intentional deception. It's always intentional. That's the key word, intentional deception. It's done for unlawful gain. It's a deliberate lie, deliberate fabrication, and it may result in civil liability, carry criminal penalties, depending on applicable law. And then you may lose your policy through rescission as well. Okay. So in short, when you hear something like concealment, it means no answer given. When you think of misrepresentation, think about wrong answer. And then fraud is an intentional wrong answer or an intentional lie, even better. Okay. So that's how concealment works. We'll just bounce through these slides because we know it. So concealment really means they know the facts. The fact makes a difference. It's material, and the applicant chooses to stay silent. Okay. So that is concealment. So have you ever been treated for heart disease and you leave it blank? Is it a known fact? Yes, the person had it in this example. It's material for sure for life insurance coverage, and that's the definition of concealment. Misrepresentation, again, is when you say something that isn't true. It's an incorrect statement. It can be intentional or unintentional, right? Unintentional is a slip of the mind, an honest mistake. An intentional misrepresentation is fraud, okay? So again, misrepresentation just means it's a wrong answer on the application. Okay? So if you report that you weigh 175, but you're actually 177, it's probably misrepresentation, okay? And unlikely to affect coverage. Fraud is that intentional misrepresentation. It's not innocent. It's deliberate. It's done for unlawful gain to win at the behest of somebody or someone else or something else. And it's intentional deception for unlawful gain. Okay. You're going to go to the slammer if you get found out and prosecuted or be sued into oblivion. So if you create fake medical records to qualify for lower premiums, yeah, that's fraud. So material facts are really important, okay? And what a material fact is information that may have, would have affected or influenced the insurer's decision, and also approve or affect things like coverage approval, premium rates, policy terms, and underwriting decisions. And the point is, if it does affect any of that, it's material. If it's not, it probably isn't material. So how do you know if a fact is material? It would just bottom line change the insurer's underwriting decision, right? So like you see the list here, if you would have known about these, think about it. If you're a life insurance company, do you think you would have given a higher rate or a lower rate depending on disclosing this or not disclosing this, right? And then sometimes like, middle name, misspelled address, that's not going to prevent the policy from getting issued. That's not a material issue, okay? So these are just an exam tree here. Use a flow chart to identify the correct concept. So start to read the scenario correctly. Did they omit information? Was it known material fact, or was it incorrect info? Okay. So intent matters too, right? So that kind of defines, was it an innocent misrepresentation? That's an honest mistake. An omission of a known fact is concealment. The intent there is to hide and not be honest. And then, of course, the intent of lying is to ungainfully or unlawfully win. And the intent matters there as well. So scenario one, an applicant forgets to mention a minor surgery from 10 years ago that had no lasting effects. We would call that misrepresentation that was unintentional. An applicant intentionally answers no to a tobacco question, knowing they smoke. Well, that's fraud. Okay, they lied on the application. Number three, an applicant does not mention a recent cancer diagnosis when completing the application. Well, that's concealment. It's lying through omission. They didn't tell the truth, even though they knew the truth. And rescission, you may have heard this term thrown around a little bit. It just means treating the contract as it never existed. Okay. And it's and where usually it applies is when there's a material misrepresentation or concealment of a known material fact later, or fraud. Okay. So rescission is not automatic. It just depends on a number of issues that go along with each individual policy. So these are the verbs that commonly come up. These are really good and important to understand. And when you see these, what they indicate. So make sure you download the slides and study these along with the flashcards and then other videos as well. So again, high frequency topic is a question like this. An applicant answers no to the question, have you used tobacco in the past 12 months? The applicant smokes every day and knows this answer is false. That would be what we call concealment, excuse me, fraud. Why? Because they intentionally provided false information. So here's the 30-second exam sheet. Again, download it. You'll get it. Here's a memory trick. All the stuff we talked about, download it. You'll get it. Let's keep going with the practice exam. An applicant intentionally fails to disclose a recent cancer diagnosis on an insurance application. Which concept is that? That is fraud, baby. Yes, B. Concealment. I'm sorry, concealment. Boy, maybe I need to go back and study my material. So they concealed it, which, could be fraud. It kind of depends, but the concealment is definitely what they did. They chose not to reveal it. An applicant accidentally reports a weight of 180 pounds instead of 182 pounds. Which concept best describes this? Fraud, intentional concealment, misrepresentation, or rescission. The answer is C. It's a misrepresentation. It's not going to be a big deal, okay, because it's immaterial. Which element most clearly distinguishes fraud from an innocent misrepresentation? Premium amount, policy delivery, intentional deception, or number of beneficiaries. The answer is C, because fraud requires intentional deception for unlawful gains. Practice exam 4. An applicant for a life insurance policy is asked on the application whether she has been diagnosed with diabetes. She was diagnosed 2 years ago, but does not disclose this because she believes it will not affect her coverage. The insurer issues the policy. 6 months later, the insurer discovers the omission during a claim review. Which of the following best describes the applicant's conduct? Innocent misrepresentation, concealment, fraud, or waiver? Excellent questions. The answer is B. Concealment is the best answer on a licensing exam because the applicant knowingly withheld a material fact that said so in the question itself. They like to generally classify knowingly withholding a material fact as concealment. Okay, so keep that difference between fraud. Very important. And then last but not least, a fact is considered material if it is included on every application and influences the insurer's underwriting decisions, is required only after claim, or increases the death benefit. The answer is B. If it makes a difference to whether or not it should be issued, it's a material fact. All right, in this training today, we're going to understand what an insurance policy is and learn about everything inside of the policy regarding things like declarations, insuring clauses, definitions, exclusions, conditions, and riders. This is really important content and understanding the foundational aspects of an insurance policy, and it's definitely tested on. So you're going to be able to identify major sections of the insurance policy, explain the purpose of each section, recognize where common exam questions come from, and then navigate a policy with confidence. So you can pass the exam. Let's go. So again, insurance policies follow a blueprint. If you open one up, they all look the same, at least in the format and their process from A to Z. So they're organized in a very similar way. And then once you learn where each section belongs, you'll be able to answer questions much faster. And instead of memorizing random facts, you'll know exactly where to look. So most insurance policies contain these core sections, though terminology and organization may slightly vary between policy type. So picture yourself, you get a life insurance policy, you got a 40-page insurance policy. You're going to read everything? Probably not. But instead, you go directly to the section containing the information you need. And that's exactly how exam thinkers are going to think in designing the exam. And so we're going to really pay attention to where they would have you focus on. So let's talk about those. The first is, and we'll go into a little more detail as we go through, the declarations page. That tells you who is insured and policy info. The insuring clause, that is the promise to pay the policy under covered conditions. Definitions, you're going to learn what the policy is using as definitions for its words along with their meanings. You're going to see exclusions. That tells you what's not covered. Conditions for coverage, meaning rules and requirements for the payout to happen. And then any riders or endorsements, which are considered changes or alterations or additions to the original policy. These sections work together to explain who is covered, what is not covered, and under what conditions the benefits will be paid. So a declarations page usually contains the policy owner information, the insured, the policy number, the effective date, the premium, the amount of coverage, what type of policy it is, and beneficiaries, okay? It's really the information page for the policy. If you're just looking for how it works, go find the declarations page and it goes over all of it, okay? The heart of the contract is the insuring clause. And what this is going to explain is what the insurer promises to do, what the losses or events that are covered, defines the circumstances under which the benefits will be paid, and the insurer's primary contractual obligation, okay? So the insuring clause means it is the promise to pay and how it does it. Definitions include insurance policies that define important terms, because ordinary meanings and legal meanings aren't always the same thing. So this is a section that just helps clarify things legally, okay? So always use a policy definition if one is provided, if there's any confusion or wonder about what to do or how to define something. So what isn't covered is covered under the exclusions section. That just tells you what situations, conditions, and losses aren't covered. Varies widely by policy type, and exclusions help define the scope of coverage, okay? Conditions mean what responsibilities that must be satisfied under the policy, like paying premiums, providing notice of claim, cooperating during the claims process, and failure to satisfy policy conditions may delay or reduce or eliminate benefits depending on the policy, of course. So again, conditions are what rules are necessary to keep the coverage in place. If you don't follow the rules, you may lose your benefits. So riders and endorsements are usually add-ons or extras that help enhance the value of the policy. And you'll see things like more coverage, less coverage, policy terms, clarifying existing provisions. And then once that's attached, it's a part of the contract. So this is the ultimate anatomy of the contract that we've talked about. If you want to get this slide as well as any others, go to Life Health Exam Coach. You can get it for free. You can go on school to get that, or the link is in below. And if you remember 6 words, declarations tell you who, insuring promises, insuring clause tells you the promise, definitions are words, exclusions are not covered, conditions are rules, and riders are changes. So again, think like the insurance exam. Who is insured? That tells you under the declarations page. What did the insurer promise? That tells you in the insurance clause page. What does this word mean? That's a definitions page. Is it covered? That's covered under exclusions. What must the insurer do? Tells you the conditions. And was the policy modified? That's the rider endorsement. So again, all of this we've covered. Feel free to pause this and look at this again. We're going to jump down to the practice exam questions here, because a lot of this is redundant. Now, how the exam tries to trick you. The declarations page describes coverage. That is not the case. Okay, it describes policy information. It's the insuring clause that describes the coverage. A common misconception is definitions create coverage. They don't. They just explain the meaning of words and policies. They don't promise benefits. Another trick, riders are separate policies. No, they're a part of the policy. They attach to the policy. Another thing, use the standard dictionary definition. Not the case. Use the definition the policy provides to understand the meaning. And if a rider conflicts with the original policy, which controls? Well, the original policy always controls. That's not the case. The rider controls because it modifies and becomes part of the insurance contract. The most recent modification takes precedence over the policy standard. So bottom line, if you want to know the basic stuff here, understand what you see on the screen here that we've covered. That kind of wraps it up. Let's do the mini exam. Which section of the insurance policy contains the insurer's primary promise to provide coverage? Is that the declarations page, the insuring clause, definitions, or conditions? And that is the insurance clause. That's where the primary promise to provide coverage is covered. A new client receives their policy and wants to find their policy number, the insured's name, and an effective date. Which section should they turn to? It would be B, the declarations page. The application question. The policy defines accident as sudden, unexpected event caused by external means. A claimant argues that their injury qualifies as an accident under their common dictionary definition, even though it does not meet the policy's definition. How should a dispute be resolved? Excellent question. The dictionary definition applies. The policy definition controls. The insurer must use whichever definition is more favorable. The state insurance commissioner determines. So the answer is B. Because remember, we go by the definitions in the policy that they signed off on. Okay. An insured's life insurance policy originally excluded coverage for death resulting from aviation activities. The insured later added aviation rider that specifically provides coverage for pilot activities. And guess what? The insured dies in a private plane crash. Is the death covered? No. Or yes. The rider modifies the original policy, but only if the insurer approves the flight in advance. The answer is C. Once that rider is attached, it takes precedence over the original life insurance exam. So here is the mental model of everything here. If you want to go through it one more time, again, head over to Life Health Exam Coach at school to download these for free. Thanks for watching. In today's training, we're going to talk about the entire contract, policy delivery, and ownership. This is designed specifically to help you understand the insurance contract portion of the life and health exam licensing studying. So let's dive in. You're going to learn exactly how the entire contract clause works, understand ownership rights of the policy, differentiate between absolute and collateral assignments, explain policy delivery requirements, determine effective dates, and then understand legal backdating rules. Okay. So this is really important to understand because most of the time you're not going to get these basic questions like, when does the coverage actually begin? You're going to get situational questions that cover the concepts and already understanding the definitions, but know how to apply them. Okay. And so that's what we're going to cover and try to help you understand through this particular training. So the entire contract clause states that the insurance policy, the attached application, if attached, and any riders, attached riders or endorsements constitute the entire contract between the insurer and the policy owner. In short, the idea behind this is it protects both parties. They can't claim like, hey, verbal promises were changed, this and that. It says that what's here in the contract is what it is, done and final. And likewise, a policy owner cannot claim coverage based on conversations that weren't in writing. Application statements are generally representations, not warranties, meaning minor misstatements don't automatically void the policy, okay? So in other words, if it's not attached to the policy, it's not part of the contract. That's what the entire contract provision really means. So it exists to protect policy owners, protect insurers, create one legal document, and eliminate those disputes that can happen. So who owns the policy? Well, so the owner controls and manages the policy. The insured is the person covered on the policy, and the policy is the legal contract between parties, okay? So you can have situations where the insured is not the owner. So for example, a parent can own their child's policy, a business can own an employee's policy, a spouse can own a spouse's policy, and an adult child owns a parent's policy. So that way you can have control and management of the policy outside of the hands of the insured, and that's totally fine. You do have rights as an owner of a policy, which include being able to change beneficiaries, borrow against cash value if it's applicable, assign ownership to others as well. You can also opt to surrender the policy, or if there are options to elect, you can do that as well, okay? The insured may have no rights if someone else owns a policy, so keep that in mind. That's why a lot of people want to own the policy so they can control some of the administrative aspects of the plan. Assignment transfers some or all ownership rights. So you're assigning who owns the policy, okay? So there's two types. You have the absolute assignment, and this is used in business sales, divorce settlements, estate planning. And the absolute assignment means there's a new permanent owner and all of the rights are transferred over. Okay. So assignment doesn't change who's insured, it just changes the owner entirely. Then you also have collateral assignments, which are used in securing bank loans, business financing, SBA loans. You'll have the owner, the collateral assignment, rights returned to the owner after repayment. The lender receives only enough rights to secure the debt and then assigns temporary limited rights until the loan is repaid. Okay. So collateral equals loan collateral minus temporary transfer. Okay. So let's ask you a question. Which assignment is commonly used to secure bank loan? The answer is B, a collateral assignment. Now, moving along, policy delivery means the insurer provides the policy to the owner. And that may be done physically, electronically, through an agent or insurer. And some policies require delivery while the applicant is still insurable. So the coverage, when does it begin? It begins after all of the steps 1 through 6 or 1 through 5 are done on the screen. So it ends at the end. This begins at the very end, as I say. So it depends on the type of receipt issued and underwriting approval, of course, not simply when the policy is delivered. Okay. So the effective date of coverage typically refers to the date the policy is enforced covering a client. This type of receipt issued at application determines potential coverage start. The coverage depends on the receipt issued in the successful underwriting, if underwriting is required. And then premium payment must be paid for coverage for it to be enforced. So there's not a single universal rule. The effective date depends on all 3 of these factors ultimately. Okay. So backdating is setting the policy effective date earlier than the application to use a younger age. So if I was 40 3 months ago, then we could start the date 3 months in the past effectively and allow to get a lower rate. So this allows us to get, you can go back 6 months at most. You have to pay additional premium in most cases, and it locks in a lower rate. Some people like that, but it's not necessarily required. So these are common exam dates here between owner and insured, absolute and collateral, delivery and effective date, entire contract consideration, and then owner and beneficiary. So make sure you understand the differences there. So which statement is true? The insured always owns the policy. Collateral assignment is commonly used in loans. Backdating increases insurance age. Entire contract includes verbal promises. The answer is C. And this is a review of all of the important points. Again, you can download these slides at Life Health Exam Coach on School or look in the description box for the link. It's completely free, by the way. We got flashcards and all sorts of stuff. And these are the key takeaways from everything. Thank you so much for watching. So in this training, we're going to talk about regarding the insurance contracts portion of the exam, specifically policy delivery, free look, grace period, and reinstatement, all important factors to understand. And so the point of this is to get you to understand all of these terminologies so you can pass your exam. So you'll understand, of course, policy delivery, constructive delivery, free look provision, grace period, policy lapse, reinstatement, contestability interaction, and then again, common exam traps where they try to get you so that you don't get that answer right. So all this matters is because the insurance company loves confusing this stuff. If you start looking at this, like policy delivered, does that mean when the coverage begins? Or is the premium late mean a grace period? Can you ever get a reinstatement? So it's important to understand how these concepts work. And so you can apply them to pass the exam. So policy deliver means the insurer providing the issued policy to the policy owner. It represents the final step before the contract becomes fully effective, okay, assuming all the other conditions are met, okay? And these typically are what needs to be involved as well. So delivery requirements include usually the first premium is paid, a good health statement, so that's on the delivery of the policy, saying everything's still fine, signed amendments and receipt of the policy. So again, delivery doesn't always activate coverage. So there's conditions that have to be met. Remember, so delivery doesn't mean you have coverage and it's activated, just it's a step in the process. Constructed delivery means the insurer gives a policy to the producer for delivery to the insured. So this legally it often counts as delivery, and physical possession by the owner is not always necessary, okay? So free look provision, this is important to understand too. This is a period of time that allows the policy owner to review the policy, return it, and get a full refund. So this is like insurance, buyer's remorse protection. So here are some free look rules depending on the products that we're selling and what the minimums are. So just make sure you screenshot that or download these slides and flashcards at Life Health Exam Coach, and you can take a look for yourself. So Sarah buys a life insurance policy, reads the policy, doesn't want it, returns it. The result is she gets a full refund, and she's under no obligation at all. The grace period defines the premium due date or after the premium due date during which coverage continues, even though the premium has not yet been paid. So the coverage remains active during a grace period. That's the key thing to remember. So typical grace period is usually 31 days for individual health. Many health policies are 7 to 31. Individual life is 31 days, sorry. So the lapse is what means the coverage just stops. The grace is what we're giving the people to get back on board paying their premiums. So example is payment is due on the 1st. The 31-day window activates. The client pays on June 20th, and there's no lapse, okay? So what happens if death occurs during the grace period? In short, the outstanding premium owed is subtracted from the death benefit. So if death occurs, you're still covered minus the premium payment, okay? So a lapse, of course, is when the policy just quits, expires, it lapses. So there's no coverage, there's no refund. A reinstatement is possible within a certain time limit, though, okay? And a reinstatement means basically restoring a lapsed policy to its original terms. And but you got to go through a bunch of steps here that we're detailing here. Submit an application, evidence insurability, pay past premium dues, insurer approval, coverage restored. Lots of steps to take in order to get something reinstated. And there is a time limit, typically 3 years, depends on the policy and the state, to upwards of 5 years. Again, just depends. It is contestable after the policy, so not necessarily on the original application. So contestability refers to the company having the state-based right to examine a claim to make sure that it actually pays in all life insurance plans. And in most cases, some states, not so much, have a 2-year contestability policy. And this takes you through the reinstatement and then the new contestability period, which applies only to statements on the reinstatement application, not the original, okay? So when does coverage actually begin? Go ahead and just screenshot this. Very important to understand the differences here, when it begins, how the conditions have to be met, etc., in order to get the coverage in place. Here's a comparison table to show you further as well. You can just pause this, read through this to understand when refunds are available, if coverage is active, and some key important points. Practice question: insured misses a premium payment. 20 days later, he dies. There's a 31-day grace period. And the answer is C, the death benefit gets paid out minus unpaid premiums. If a policy owner returns a newly delivered policy with a free look period, they have to C, refund the premium. And then what usually must be provided when requesting reinstatement. And typically that's B, evidence of insurability. So here are your key takeaways here today, guys, on how things work. Delivery completes the issuance process. Free look allows cancellation for a full refund. Grace period keeps the coverage active after missed payments for a period of time. Policies lapse after the grace period expires, and then reinstatement generally requires proof of insurability and repayment of missed overdue premiums. And this is our master life cycle about how all of this fits together and how it all works: grace periods, lapses, and reinstatements. Okay, in today's insurance contract training for the life and health exam, we're going to talk about waiver and estoppel, specifically meaning when insurance companies lose the ability to enforce their legal rights, which are very important. They show up on the exam a lot, so it's important to understand what they mean and how to apply them in different contexts. So we'll explain how waivers and estoppel works and when it applies, the differences, recognize the common exam traps, and then get you prepped up so that you can pass this exam and start selling insurance. So insurance companies may lose the ability to enforce certain rights, not because of law change, because of their own actions. So you may have a situation where the contract didn't change, but their conduct matters, right? So how they approached the situation. And so there's these two legal doctrines called waiver and estoppel, commonly confused but legally distinct, that apply to these situations where legal rights are taken from the insurance company. So how can an insurance company accidentally lose legal rights? So for example, let's say a policyholder misses a premium payment. The insurer knows, but they keep accepting payments for months, okay? An insurer later tries to claim the policy lapsed on the first missed payment. And sometimes the answer is no, they can't. So it's not that the insurance contract didn't change, it's that their ability to enforce it may have because of their behavior, okay? And so this is where waiver and estoppel come in. So a waiver is a voluntary and intentional relinquishment of a known legal right. So it can be express or implied. So let's talk about it. So voluntary means insured chooses to they actively give up the right. Intentional is it's a deliberate decision. So they intend to give it up. And it's a known right. The insurer must be aware of the right it is waiving. So very completely conscientious of doing it. So some examples include waiving a medical exam requirement, waiving a waiting period, accepting repeated late premium payments. So these are, again, voluntarily intentional relinquishment of a known legal right. So the best way to remember this is we voluntarily won't enforce that right. We decide not to enforce it. So express versus implied. An express waiver means the insurer clearly and directly states it's giving up the right. So they'll say things like, well, we'll waive the medical exam requirement. We'll waive the 30-day waiting period. There's no ambiguity. They just explicitly communicate the decision. Now, sometimes there's an implied waiver. Now, because based off of their actions, they indicate they give up the right, even without saying so. So example, repeatedly accepting late payments without objection. So they accepted it. They didn't need to explicitly say it. The conduct spoke for itself. So both types of waiver are legally valid and both appear in a licensing exam. Express waiver is stated directly. Implied waiver is assumed through conduct. Okay. An implied waiver is, again, action speaking louder than words, repeatedly, over and over again, reinforced through behavior, not an isolated incident. It's very important to understand the distinction. So this creates a waiver in many situations, accepting a late payment for 12 consecutive months, consistently ignoring policy violations, or repeatedly waiving a required document. What's unlikely to create a waiver is accepting a one-time isolated late payment as a courtesy, a single isolated exception, or an accidental oversight. Okay, so the key thing is repetitively, repeatedly, consistently, or pattern of conduct. That's an implied waiver. So this is an example of the waiver example. Just seeing a pattern of behavior is the key thing. Now let's talk about estoppel. Estoppel prevents a party from asserting a legal right because its previous words, actions, or conduct induced another person to reasonably rely on it. So in other words, prior conduct, let's say we have an insured said or did something that created an expectation, and we have a level of reasonable reliance on that. The policy owner believed and acted on that expectation. This is the key element that distinguishes estoppel from waiver. And so we have an inconsistent position. The insurer now tries to act contrary to what it said or did previously. So in other words, estoppel means you can't take it back after I relied on you. And the thing you see a lot from is reasonable reliance. Like, it makes sense to depend on them based off their actions. So let's look at an example to help clarify this. This can sometimes be a little confusing. So let's say an insurer repeatedly tells the policy owner, don't worry about paying exactly on the due date. So the policy takes the insurer at its word. And so the policy owner changes their behavior based on the insurer's statements. That's reasonable reliance because they said so. Then the insurer reverses course and says, well, we're going to deny coverage because the premiums were paid on time and all this stuff. And now estoppel may apply. They may be prevented from taking this inconsistent position based on their actions, okay? So the key and critical element is the policy owner reasonably relied on the insurer's own statements. And if there wasn't this reliance, then estoppel likely doesn't apply, okay? So here's a side-by-side comparison. If you want to take a screenshot of this, or again, download the slides, look at flashcards at Life Health Exam Coach at School. Direct link is in the description box below. So what's the relationship between these two? Because they're heavily tested and there's a similar relationship. So the company repetitively gives up the right. The insurer accepts late payments, ignores violations, or fails to enforce policy provision. The insurer now has voluntarily and intentionally relinquished a known legal right, so the waiver occurs. Now, the policy owner relies on that conduct. They reasonably believe the insurer will continue to act the same way based on a pattern of conduct, and now estoppel may also apply. So the insurer may now be prevented from recovering or reversing course and asserting the right it previously gave up. So waiver often comes first, and then estoppel arises when someone reasonably relies on that waiver, okay? So is it waiver or estoppel? Let's look at some framework. Did the insurer intentionally give up a known legal right? Well, if no, then it's not a waiver or estoppel at all. Okay, they didn't relinquish anything. If yes, then a waiver applies. Okay, the insurer voluntarily relinquished an known right. And did the policy owner reasonably rely on the insurer's conduct? Okay, so start with the waiver, then ask if there is reasonable reliance. If yes, estoppel applies. So these are common licensing words. Again, these keywords are really important to understand, so make sure that you study these. And understand the purpose of all this is that the law promotes fairness, okay? What the law is trying to do here with waiver and estoppel is getting insurance companies to act consistently. They got to honor the patterns of conduct they establish. They got to honor their conduct. So past actions create reasonable expectations, and they have to avoid misleading policy owners. Insurance cannot say one thing and then do another. So that prevents unfair surprises. So you have to understand the law does not allow insurers to benefit from their own inconsistent behavior. So some myth and reality exam tricks. Waiver and estoppel mean the same thing? No. Waiver means giving up a right. Estoppel means preventing inconsistent conduct after reasonable reliance. Okay. Myth number 2, every late premium payment automatically creates a waiver. No, it's not an isolated incident. What creates the waiver is a pattern of behavior intentionally done, and that is what creates a waiver. Another myth is estoppel can create insurance coverage where none existed, and the reality is estoppel may prevent inconsistent conduct, but it generally cannot create coverage for a risk policy that never insured in the first place. Okay, this one is the most frequently tested in advanced licensing exam concepts. Estoppel prevents unfair reversals. It may not create new coverage. Keep that in mind. So some real exam case scenario study. So for 2 years, the insurer repeatedly accepts late premiums every single month. The insurer never warns the policy owner. That establishes a pattern of conduct. Claim is submitted. The insurer denies the claim. Which doctrine applies? The example answer is waiver. There's a waiver because of the repetition of the conduct produces a reasonable expectation of what to expect with the possible estoppel. So before the exam, here's everything you need to know. Again, on how things work, make sure that you understand it. 30-second test. When you see a waiver or an estoppel question on the exam, ask yourself, did the insurer give up a known legal right? If they did, because of voluntary, intentional, or repeated conduct, that's a waiver. Did the policy owner reasonably rely on that conduct? That's estoppel. And if both occur, then both doctrines may apply to both. Okay. So another way to look at this is waiver focuses on the policyholder's conduct. The insurer's conduct. Waiver focuses on the insurer's conduct. Estoppel focuses on the policy owner's reliance. All right. So some practice exams. A waiver is best defined as an insurance rider, the voluntary relinquishment of a known rider, material or misrepresentation, or policy exclusion. The answer is B. Which concept prevents a party from asserting a legal right after another party or another person reasonably relied on its previous conduct? Adhesion, aleatory, estoppel, representation. The answer is C, estoppel. It's a definition. An insurer accepts late premium payments for several years without objection. Which concept most clearly illustrated? The answer is waiver, A. An insurance agent tells the policy owner, hey, don't worry about the medical exam. We never actually require it for this type of policy. The policy owner applies without completing the exam. The insurer later tries to deny the claim because no medical exam was on file. Which doctrine most likely would prevent the insurer from denying the claim? And the answer is A, because this is a statement, the agent's statement that the medical exam was not required may constitute an express waiver of that policy requirement. And last question. For 18 months, an insurer repeatedly tells the policy owner, pay whatever you can. We're flexible on due dates. The policy owner consistently pays late, relying on those assurances. The insurer then denies the claim, arguing policy lapse due to late payments, and describe what happens. Only waiver applies because the insurer gave up its rights to enforce a due date. Only estoppel applies because the policy owner relied on the insurance statements. Both waiver and estoppel apply. Waiver because the insurer's repeated conduct, and estoppel because the policy owner reasonably relied on the insurer's assurances. Neither doctrine applies. The answer is C. So the waiver happened first. It was presumed, and then the estoppel happened because we depended on what they said, and now they're pulling it back. And you can't do that. In this lesson, we're going to learn about the principle of indemnity as it relates to insurance and what you need to know to pass the insurance exam. So, one of the things you have to understand is insurance is not designed to make you rich. Now, maybe if you sell insurance and you do it successfully, it is, but the act of getting an insurance policy is not. Okay. So, we're going to get into the meat of this. Of course, we're going to define what principle of indemnity means, the policy types, exam strategies to prepare yourself, major exceptions, there are a few, and financial restoration, why that's important. So, the principle of indemnity means that insurance is designed to restore an insured to approximately the same financial position they occupied before a covered loss without allowing them to profit. Back to what we talked about previously. Okay. A pure risk means there's no possibility for gain. So, again, the idea here is to restore the pre loss financial position, to not profit from said loss, and that it's a measured repayment limited by the actual covered loss and the policy's terms, conditions, and limits. Note that the replacement cost coverage still follows the principle of indemnity because payment is limited by the policies intended to restore and not improve the insured's financial position, just in case there's any confusion on that. So again, memory tip here to help you understand principle of indemnity. Insurance replaces losses, not creates wealth. Okay. So this exists because insurers pays more than the actual loss potential. If that happens, then there's this incentive that's created in the system where policy motivators or policyholders are motivated to destroy property. Then fraud skyrockets, premiums soar, and then the availability of the insurance product just is not there anymore. Okay. So indemnity limits payment to the actual covered loss, and that keeps insurance focused on protection and not profit. Okay. And keeps the pool of insurance alive so that people can benefit from having that promise of protection. So an example of this is that Sarah has an auto claim insurance experience. Her car is worth 20 grand. A covered accident totals the vehicle. She files a claim. The insurer pays vehicle's covered value under the policy less than deductible, and Sarah's returned to her pre-loss financial position. So she's not paid 30, 40 grand, whatever she wishes, because that creates those bad incentives that will end up bankrupting the insurance company. What she is paid is the vehicle's covered value under the policy, less than deductible. And that insurance made her whole, not wealthy, or just got her back to where she was financially speaking. So which insurance follows indemnity? Well, homeowners insurance does, auto physical damage, commercial property, business owner's policy, liability insurance. They're all designed to have you recover from the actual financial loss, subject to the policy terms and limits, of course. The major exception to this is life insurance. Okay. So on the exam, it is the one thing that it doesn't follow the principle of indemnity. Life insurance is a valued contract. Okay. Keyword is valued contract. It pays a predetermined death benefit, not the financial value of the person's life. So indemnity contracts like PNC, payment is based on the actual financial loss. It can be measured and documented, cannot profit from the loss. Whereas a valued contract pays a predetermined death benefit. There's no attempt to measure economic value of life in the payout and the benefit agreed upon at the policy inception. So a person earning 40 grand and one earning 40 grand or 400 grand a year can each own $1 million life insurance policy, and both will receive their full death benefit. So remember, on the exam, life insurance is a valued contract, not an indemnity contract. Okay. So a test of your knowledge here. A homeowner suffers a $40,000 loss. Their home is insured for full value of the loss. How much should the homeowner be paid from the insurer? Is it A, B, C, or D? The answer is B, $40,000. Again, principal indemnity restores the insurer to their previous pre-loss financial position. Okay. Common student mistakes here that we see on the exam include no profit. Insurance is not designed to create a profit from a loss. Never, 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 never. It is not an investment. Insurance is not an investment vehicle or wealth building tool, ever. Insurance is not free money. Insurance does not pay whatever the insured requests. That doesn't happen. Insurance restores financial loss. It's designed to restore and compensate and protect, nothing more. Okay. It makes you whole, not wealthy. In property insurance, restores the home's value. Auto insurance restores the vehicle's value. Commercial restores the business property's value. Homeowners restore. Restore is the key word. Okay. So the key takeaways here include restoring financial position for all these different types of products. Most PNC policies follow the indemnity principle. Exam keywords to look out for are restore financial position. That's key principle of indemnity. No profit is allowed from a covered loss, with the exception of life insurance. It's a valued contract, not indemnity, so a bit different. Okay. Nicely done. You completed today's lesson. But before you go, make sure you join the completely free Life Health Exam Coach training website. There you'll find more training on specifically helping you pass the life and health insurance exam, no matter what state you're in. We offer free slides for all of our trainings for you to review, free flashcards to help you memorize and learn the content to pass the exam. And again, all of this is completely free. To get access immediately, click the link below in the description box, and I will see you there.